So right now, there is a company living in your pantry.
Yeah, quite literally in almost every pantry, honestly.
Boy, and they don't have their logo on a single cereal box. They don't sponsor any major sports teams.
No Super Bowl commercials for these guys?
Exactly. You will never see a commercial for them. Yet, if you have eaten anything out of a package today or poured a beverage or, I don't know, even consumed a protein bar, you have almost certainly interacted with their products.
Without a doubt, they're everywhere.
And right now, largely due to this massive, almost civilization level shift in how we eat, which is, driven in part by the explosion of those GLP-1 weight loss drugs.
Oh, yeah. The Ozempic effect, it's changing everything.
It really is. And because of that, this kind of invisible monopoly is undergoing one of the most painful yet potentially profitable transformations in modern finance.
It is a phenomenal, hidden in plain sight story. We are talking about Ingredion Incorporated.
Ticker symbol INGR for those tracking at home.
All right, INGR. And for this deep dive, we've been really stripping down the data from their fourth quarter and full year 2025 earnings call. And our mission today is to just cut through all the corporate jargon, give you the headline numbers, and figure out if this stock is a buy, hold, or sell.
Because if you just screen this stock on a basic financial terminal, the numbers look completely contradictory.
They make zero sense at first glance.
Right. You see revenues shrinking at the exact same time profit margins are expanding.
Which is always a huge red flag, or a giant question mark for investors.
And you're going to see their critical manufacturing infrastructure literally breaking down while the company simultaneously increases their dividend payouts.
It is the absolute definition of diagnostic muddy waters.
It really is. I mean, if I'm a retail investor and I run a basic stock screener just looking for, top line revenue growth, Ingredion gets filtered out immediately.
Oh, instantly.
Yeah.
Wouldn't even make the first cut.
So let's actually look at these headline numbers because they are jarring. Net sales for the fourth quarter came in at $1.8 billion.
Which is down 2% year over year.
Right, down 2%. And adjusted operating income was $228 million, meaning their earnings per share operationally decreased by 23 cents in that fourth quarter.
Yeah, so immediately the alarm bells are ringing. You see falling sales, you see a hit to earnings.
But then, and this is where it gets weird, you zoom out to the full year 2025. Full year net sales were $7.2 billion, which is down 3% year over year.
Still down, yeah.
Still down. Yet, here's the paradox. Their full year gross margin actually hit a record 25.3%.
A record margin on falling sales.
Exactly. And their full year adjusted earnings per share was actually up 4.5%.
Which naturally forces you to ask the fundamental question of corporate finance, right? Like, how do you make more money while selling less stuff?
Exactly. Hold on, because to a skeptic, this just sounds like corporate spin for, hey, we lost market share, but we fired a bunch of people to make the spreadsheet look good.
Shrinking to greatness, as they call it on Wall Street.
Right, shrinking to greatness. So is this actually sustainable growth, or is it just financial engineering? Or are they just squeezing blood from a turnip here?
It's actually entirely sustainable. But to understand why, you have to understand the mechanics of commodity pass-through pricing.
Okay, pass-through pricing. Break that down for me.
And it also ties into a strategy Wall Street calls quality over quantity. So let's look at the actual physics of their revenue. Ingredion is a massive buyer of raw agricultural inputs.
Like, what are we talking about? Corn?
Primarily corn, yeah, and tapioca. Historically, companies in this legacy agricultural processing space, they chased pure volume.
Right. They just wanted to move as much product as possible.
Exactly. They wanted to grind millions of tons of corn and sell millions of tons of basic low-margin commodities. Think high fructose corn syrup.
Which is the absolute bedrock of the processed food industry. It's in everything.
It is. But the contracts for those basic commodities, they're usually structured to pass the raw material costs directly through to the customer.
Ah, okay. I think I see where this is going.
Yeah, so if the global price of corn drops, which it recently happened, Ingredion pays less for the corn, obviously.
Right.
But they're also contractually obligated to charge, Coca-Cola or Kraft Heinz less for the finished syrup.
Let me make sure I have this mechanical linkage right, because this is crucial.
Go for it.
So if a bushel of corn drops from, say, $6 to $4, Ingredion's top-line revenue shrinks because they are charging the customer less.
Yes.
But their actual gross profit, like The actual dollars they keep in their pocket per ton of syrup, that remains exactly the same.
Precisely. The dollar amount of profit stays completely flat.
Wow, okay.
But because the total revenue number, which is the denominator in the margin equation, has shrunk, the profit margin percentage mathematically goes up.
That is fascinating. So the top line looks worse, but the actual cash they keep relative to sales looks better.
Exactly. But that's really only half the story. The other half is this intentional, aggressive pivot in their product portfolio.
The quality over quantity part.
Right. Ingredion is deliberately stepping away from that race to the bottom commodity game. Because if you just sell basic corn syrup, you're competing purely on fractions of a penny against every other wet miller on the entire planet.
It's a brutal business.
It is. But if you sell a proprietary, highly engineered blend of, say, sweet proteins and stevia...
Something that mimics sugar, maybe?
Exactly. Something that mimics the exact mouthfeel and the baking properties of sugar. But without the calories, you aren't just selling a basic ingredient anymore.
You're selling intellectual property.
You're selling IP, and you can charge a massive premium for that.
Okay, so they are intentionally shedding the low-margin bulk volume to focus on these high-margin specialty items.
That's the strategy, yes.
And looking at the transcript, management actually provided the bridge for this on the call. That 2% decrease in Q4 net sales, it was driven by $40 million in lower volume and $39 million in lower price mix.
Which is that pass-through dynamic we just talked about.
Right, the pass-through. But it was offset by $36 million of favorable foreign exchange. But here's the problem I have.
What's that?
If they are so successful at selling these high-margin, futuristic food components, how can overall sales still be down 3% for the whole year?
That is the big question.
That paradox really forced me to look under the hood at their segment breakdown. And it turns out we aren't looking at one unified company here.
Not at all.
We are looking at two completely different businesses chained together under one ticker symbol.
It is very much a Jekyll and Hyde situation.
That's the perfect way to put it.
You have the legacy industrial business, which is just struggling immensely, and you have this futuristic ingredients business, which is booming.
Let's start with the boom. Let's do the good news first.
Okay, the good. The undeniable star of the show for Ingredion right now is their Texture and Healthful Solutions segment.
THS, for sure.
Right. In the industry, they just call it THS. And this specific segment posted its 7th straight quarter of volume growth. It was up 4% in Q4 alone.
Wait, I need to pause on that.
It's a big number.
7 consecutive quarters of volume growth in the current consumer packaged goods environment is frankly absurd.
It really is defying gravity.
Because we have seen massive CPG companies, the folks who make the snacks and drinks, reporting flat or negative volumes for the last year and a half because of inflation. The consumer is exhausted.
Absolutely.
So how is Ingredion's THS segment dodging that macroeconomic bullet?
Well, it's because they are selling the exact solutions that those struggling CPG companies desperately need to fix their own margins.
Ah.
For the full year, the operating income for the THS segment was up 16%.
16%.
And those margins we were talking about earlier, they expanded by over 200 basis points for the segment, reaching 16.9%.
You know, for listeners outside of manufacturing, expanding your gross margin by 2 full percentage points on a billion-dollar segment is not just a rounding error.
No, it's massive.
That is a structural transformation of the business. So what exactly is the mechanism here? What is physically flying out of the THS factories that commands a 17% operating margin?
It essentially boils down to two distinct but overlapping consumer demands: clean label ingredients and solution selling.
Okay, let's tackle clean label first.
Sure. So if you walk down a grocery store aisle today, right, you flip over a box of crackers or a bottle of salad dressing, what is the first thing you look for?
Honestly, I'm looking for an ingredients list that doesn't read like a chemistry textbook.
Exactly.
If I see modified food starch or polysorbate 80 or high fructose corn syrup, I usually just put it back on the shelf. I want to see ingredients I can actually pronounce.
Right. And the entire food industry knows that you do that.
They're terrified of it.
They are. Consumer preference has violently shifted toward authentic, simple ingredients. But here is the massive engineering problem for the food companies.
Okay.
Those unpronounceable chemicals, they were doing a job.
They weren't just in there for fun.
Exactly. They kept the salad dressing from separating on the shelf for 6 months. They kept the crackers crispy during transport across the country.
Right.
If Kraft or Nestle remove those artificial chemicals just to get a clean label, the food literally falls apart. or it tastes terrible.
So they need a natural replacement that performs exactly like the artificial chemical it's replacing.
Right. And Ingredion is the global leader in extracting natural texturizers from things like tapioca, potato, and specialized corn strains that allow food companies to achieve the exact stability and mouthfeel they want.
But the ingredient list just says tapioca starch.
Or pea fiber, exactly. The consumer is happy, the food company gets their clean label premium pricing, and Ingredion gets to charge a massive markup because that natural extraction process is highly technical.
Which brings us to the second driver you mentioned, solutions selling.
Right.
During the earnings call, management noted that their solutions business in 2024 and 2025 was just over $1 billion.
A huge chunk of change.
And they made a really specific point to highlight that the gross margins on these customized solutions are between 30 and 35%.
Which is astronomical for an ingredient supplier.
That is roughly 5% higher than the already impressive segment average. But what exactly does solution selling mean on the actual factory floor? Are they just putting like different starches in a bigger bucket?
No, it's much more complex than that. Think of it as the difference between buying lumber versus buying a prefabricated house.
Okay, I like that analogy.
Historically, Ingredion sold lumber, raw starches, basic sweeteners. The food company had to figure out how to put them together to build the food.
They had to do the carpentry.
Right.
Right.
Now, Ingredion is operating almost like an outsourced research and development lab. This is exactly why they recently invested heavily in expanding their blending center of expertise in Belcamp, Maryland.
I saw that in the transcript. They noted that the Belcamp expansion increases their customized solutions revenue potential by $30 million a year.
Yeah, $30 million.
But what actually happens inside that blending center? Paint a picture for me.
Okay, so imagine a massive CPG company comes to Ingredion and says, hey, we want to launch a vegan, plant-based cheese slice.
Okay, very trendy.
Right, and they say it needs to melt exactly like mozzarella. It needs to have the same protein content as dairy cheese, but here's the catch. We can't use any dairy, obviously, and we can't use soy because of allergen warnings. Fix this for us.
That sounds like a nightmare food science problem.
It is, but the food scientists at Belcamp will go to work. They will figure out the precise microscopic ratio of modified potato starch to give it the stretch.
Wow.
Then they'll add pea protein isolate for the nutritional profile, and specific natural hydrocolloids to bind all the water and fat together.
So they're engineering the whole recipe.
They create this proprietary, highly complex powder matrix. They bag it, label it as a custom solution, and ship it to the CPG company.
And the CPG company just has to, what, add water and fat?
Basically, yeah. They just add water and fat, extrude it, and boom, they have vegan mozzarella.
That's incredible.
And because Ingredion solved the entire engineering problem for them, they capture a 35% margin on that powder.
Okay, that makes perfect sense. They are monetizing their intellectual property and their food science expertise, not just the raw agricultural commodity.
Exactly.
And, when you look at the raw data from the transcript, the ultimate validation of this strategy is their protein fortification business.
Oh man, the numbers here are staggering.
They really are. They saw a 40% net sales growth in protein fortification.
40%.
And the operating loss for that specific unit improved by over $20 million versus the prior year. 40% growth for an ingredient supplier is practically unheard of unless there is a massive external catalyst.
And there is a massive external catalyst. It was the absolute elephant in the room during the entire earnings call.
The analysts definitely wanted to talk about it.
Oh, yeah. In fact, during the Q&A portion, an analyst from Stevens explicitly asked management about the impact of GLP-1 weight loss drugs.
Right. The Ozempic effect. We really cannot talk about the modern food supply chain without talking about how these drugs are fundamentally rewiring human biology and, by extension, consumer habits.
It is the most significant demand shock the food industry has faced in decades.
Yeah.
Maybe ever.
So let's trace the exact biological and market linkage here because it explains that 40% growth perfectly.
Yeah, let's break it down. So GLP-1 agonists essentially mimic a hormone that targets the appetite center of the brain.
Right.
And it drastically slows down gastric emptying. The stomach physically stays fuller for longer.
So people just don't feel hungry.
Exactly. Because of this, patients on these medications eat roughly 20 to 30% fewer calories overall.
Which is terrifying if you are a company whose entire business model relies on selling massive volumes of snack foods.
It's an existential threat to them. If the population physically cannot eat as much volume, your sales collapse. But this creates a secondary critical medical issue. sarcopenia, or the loss of muscle mass.
Right, because when you lose weight rapidly on a GLP-1 drug, a significant portion of that weight loss isn't just fat.
It's lean muscle tissue.
Which is dangerous.
Very dangerous. So the medical community and now the broader consumer market have violently pivoted toward preserving muscle mass.
Meaning protein.
Yes. So what happens to the consumer's diet? They stop eating the 300-gram bowl of empty calorie pasta.
Right.
And they start looking for a 2,100-gram snack bar that somehow packs 30 grams of protein.
They need profound nutrient density in much smaller portions because they physically can't eat a big meal.
Right. And here is where the physics of food engineering hits a massive wall.
Why?
Because if you try to pack 30 grams of plant-based protein like pea protein or soy into a tiny 100-calorie bar, the rheology of the product breaks down completely.
The rheology, meaning the texture.
The texture, the flow, the structure. Have you ever eaten a cheap, extremely high-protein bar?
Oh, yes. And it tastes like chewing on drywall. It literally turns to sand in your mouth. It absorbs all the moisture and is incredibly difficult to swallow.
Right, and that is the natural behavior of highly concentrated plant proteins. They bind water aggressively and create this gritty, chalky texture.
Nobody wants to eat that.
And the food companies know that. They know that if a protein bar tastes like sand, the consumer will buy it exactly once.
So they have to fix the sand problem.
Yes. So they go to Ingredion's THS segment. Ingredion takes raw pea protein and puts it through advanced physical and enzymatic modifications.
They're changing the protein at a microscopic level.
Exactly. They alter the microscopic structure of the protein matrix so that it still delivers all the necessary amino acids.
But it doesn't ruin the food.
Right. It suspends smoothly in a liquid shake, or it remains soft and chewy in a baked bar instead of turning into concrete.
This is what management meant on the call when they talked about increasing the valorization of pea starch, pea fiber, and pea protein isolate.
That's the corporate speak for it, yes.
They are extracting maximum value by solving the exact textural nightmare that GLP-1 diets have created for these food manufacturers.
Exactly. And because of this dynamic, management noted on the call that their protein fortification business is essentially fully contracted for the entirety of 2026.
Wow. Fully contracted. They literally can't make it fast enough.
The consumer pull is that strong. The food companies are panic buying these specialized proteins because they are required to formulate for the Ozempic era.
Okay, so that is the THS segment. It is sleek, it is high margin, it is deeply embedded in the most powerful consumer trends of the decade, and it is just firing on all cylinders.
It's a beautiful business.
It is. And if Ingredion was only the THS segment, this stock would be trading at an astronomical multiple.
Ooh, Wall Street would love it.
But as we established at the top of the show, they're dragging a massive legacy anchor behind them.
A very rusty, very expensive anchor.
And for 2025, that anchor was the U.S. Canada food and industrial segment. This is the bad part of our Jekyll and Hyde equation.
It was a brutal year for that segment. The data is just grim.
Hit me with the numbers.
Q4 sales tanked 9%, with volume down 7%.
Ouch.
And for the full year, net sales were down 7%, and operating income dropped 16% to $315 million.
Those numbers represent a phenomenal amount of wealth destruction within that specific division.
They really do.
So we need to put this on the diagnostic table. What exactly went wrong here? Why is this segment bleeding out while the rest of the company is thriving?
It was a cascade of failures, honestly. A perfect storm of internal operational breakdowns colliding with external macroeconomic headwinds.
Let's start with the internal breakdowns.
Internally, the bleeding centered almost entirely around their Argo facility in Illinois.
Argo. I saw that name all over the transcript.
Yeah, this is their flagship legacy corn wet milling plant. It is a massive, sprawling industrial complex.
Right.
And throughout the fourth quarter, it was plagued by persistent operational shutdowns.
Right. Let's actually define what a grind shutdown at a corn wet milling plant means.
Good idea.
Because I think a lot of retail investors just hear the word shutdown and they assume it's like, turning off the lights in an office building for a few days to save some money.
Right, like everyone just goes home for the weekend.
Exactly. But from a manufacturing perspective, shutting down a wet mill is closer to an industrial catastrophe, right?
It is an incredibly violent event for the balance sheet. Corn wet milling is not just like grinding dry kernels into flour in a blender.
What is it then?
It is a massive, continuous chemical and mechanical process. You take thousands of tons of raw corn and you steep it in these massive stainless steel tanks with warm water and sulfur dioxide for 48 hours.
Just to soften it up.
just to soften the kernel. Then it goes through this crazy labyrinth of degerminators, centrifuges, and hydrocyclones to separate the starch, the gluten, the fiber, and the germ.
Honestly, it sounds like an oil refinery, but for biological material.
That is the absolute perfect analogy. And just like an oil refinery, a wet mill is designed to run 24 hours a day, 7 days a week, 365 days a year.
It never stops.
It can't. The physics and the economics of the plant require constant, uninterrupted flow.
What happens if it does stop?
If the machinery breaks down, or if you lose power, you cannot just hit a pause button and walk away.
Because the corn is wet?
Exactly. You have miles of pipes filled with biological material that is actively fermenting.
Oh, wow. So it rots.
And if it sits still, it spoils.
Uh-huh.
Or worse, it solidifies inside the pipes.
That sounds like a nightmare.
It is.
Yeah.
You have to aggressively flush the entire system, sterilize it, bring in emergency maintenance crews, and then very carefully ramp the temperature and pressure back up over several days.
So a 3-day mechanical delay doesn't just cost you 3 days of lost sales.
Not at all.
It costs you a small fortune in emergency maintenance, wasted raw materials, and cleanup.
And it triggers what we call in the industry poor fixed cost absorption.
Okay, poor fixed cost absorption. This is a critical concept to understand when analyzing industrial stocks, so let's break it down for the listener.
Think of the Argo plant like the engine block of a massive cargo ship. Whether that ship is moving at full speed across the Pacific or sitting completely broken down in a harbor, the daily costs are largely the same.
Because you still have to pay the crew.
You're still paying union wages for the crew. You are still paying massive property taxes. You are still absorbing the multi-million-dollar depreciation on the machinery.
Right. So if the plant costs, let's say, $500,000 a day just to exist and operate, and you produce 10,000 tons of syrup.
That fixed cost is spread thinly across a massive volume of product.
But if the plant breaks down, and you only produce the 1,000 tons of syrup while you're scrambling to restart it,
that exact same $500,000 daily cost is absorbed by a tiny fraction of product. Your profit margin per ton completely evaporates. It turns deeply negative.
Exactly. And the financial damage of that core absorption is very quantifiable here. Management explicitly stated on the earnings call that the operational issues at the Argo plant cost the company $16 million in the fourth quarter alone.
$16 million in just 3 months.
And roughly $40 million for the full year 2025.
$40 million completely vaporized just because they couldn't keep the continuous flow continuous.
That is a massive bleed. And then looking at the transcript, as if the internal mechanical failures weren't enough, they got hit by a weather event right at the end of the year.
Yeah, the persistent Argo issues in late Q4 spilled directly into a severe, prolonged cold snap in January.
And as we just discussed with the wet milling process, freezing temperatures are the absolute enemy of a plant that relies on pumping heated biological liquids through outdoor pipelines.
It's the worst case scenario.
Yeah.
It exacerbated all of the restart delays, pushing millions of dollars of operational penalties directly into their Q1 2026 books.
So the factory floor was a complete mess.
It was.
But even if Argo had been running perfectly, management noted that the external demand for this segment's products was unusually soft.
Yeah, the macro environment didn't help.
Specifically, they called out weakness in overall beverage sweetener demand in the back half of the year.
High fructose corn syrup sales were sluggish.
Why is demand for high fructose corn syrup suddenly dropping? Did everybody just decide to stop drinking soda at the exact same time?
Not voluntarily, no. It comes down to basic price elasticity demand, which is heavily driven by the broader inflationary environment.
Okay, how so?
Jim Gray, the CFO, detailed this dynamic quite clearly on the call. We have seen massive, persistent price increases across the entire beverage category, specifically canned sodas and beers.
Oh, I've absolutely noticed this. A standard 12-pack of name brand soda used to be, what, $4 or $5 on sale?
Exactly.
Now you walk into a grocery store and they are pushing $8, $9, sometimes $10 for a 12-pack. It's crazy.
And there is a complex supply chain reason for that. It's not just the CPG companies being greedy and jacking up the price.
Right, they have costs too.
They are facing severe inflation on the packaging side. Aluminum tariffs and increased global demand for metals have made the physical can significantly more expensive.
The can itself costs more.
Yes. And the transportation costs to ship heavy pallets of liquid have increased. So the bottlers, the Cokes, the Pepsis, the major brewers, they have passed all of those compounding costs directly onto the consumer.
But there is a psychological breaking point for the consumer, right?
Always.
At a certain point, a $10 12-pack of soda stops being a casual grocery addition and starts feeling like a luxury purchase.
Exactly. And that breaking point is what economists call price elasticity. The consumer finally balked.
They said, no, I'm not paying $10 for Diet Coke.
Right. They didn't necessarily stop drinking soda entirely, but they started buying less of it. Maybe they buy a 12-pack every 2 weeks instead of every week.
That makes sense.
And that small fractional reduction in volume at the grocery store checkout line creates a massive bullwhip effect all the way down the supply chain.
Right, because if consumer volume drops by 5%, the regional bottler scales back their production runs by 5%.
Exactly.
And if the bottler scales back, they order 5% less high fructose corn syrup from Ingredion.
And as we just discussed with the Argo plant, a wet mill is designed to run at 100% capacity to absorb its fixed costs.
Oh, I see where this is going.
Right. If demand drops by 5% and you have to throttle the plant down, your margins compress violently. You lose that fixed cost absorption.
Just a vicious cycle.
It is. And just to add a final layer of absurdity to the U.S. Canada segment's bad year, they also suffered a train derailment in Cedar Rapids earlier in 2025.
A literal train wreck, to cap off a figurative one.
You can't make it up.
Yeah.
It was a relatively small derailment, but in a highly optimized supply chain, it caused localized logistics failures that cost the segment another $10 million in alternative freight and lost time.
Another $10 million. So when you combine the $40 million Argo penalty, the $10 million train derailment, the freezing weather, and the elastic collapse of soda demand.
It is actually a miracle that the segment only dropped 16% in operating income.
Honestly, yes, it could have been so much worse.
It was a very resilient performance given the chaos.
Okay, so that paints a very clear, very stark picture of 2025. You have the THS segment building the future of food science, and the U.S. Canada segment bleeding out from legacy industrial failures.
The Jekyll and Hyde.
Exactly. Which naturally leads us to the most critical part of this deep dive for anyone looking at the stock today: management guidance and the outlook for 2026.
This is where it gets really interesting.
Because based on this transcript, 2026 looks like a tale of two entirely different halves.
It is a distinctly bifurcated year. Let's look at the broad strokes first. The full year 2026 projections.
Okay, full year.
Management is guiding for net sales to be up low to mid-single digits.
Not bad.
Right. They expect full year adjusted earnings per share to land between $11 and $11.80.
Solid.
And crucially, despite all the industrial chaos we just discussed, they project their cash from operations to remain incredibly robust, landing somewhere between $820 million and $940 million.
So on paper, a full year projection of single-digit top-line growth and nearly $1 billion in cash flow sounds like a very steady defensive industrial play.
It sounds totally fine, right?
Right. But reading the transcript, management practically dropped a flare on the runway for the first quarter.
Oh, they definitely did.
They issued a massive neon flashing warning label for Q1 of 2026.
They absolutely did. This is the core of the short-term bear case. Management was unusually blunt on this call.
What did they say?
They told investors, essentially, do not look at the Q1 print expecting a turnaround.
Wow.
Yeah. They are projecting Q1 sales to be down low single digits. But more alarmingly, they expect Q1 operating income to be down mid-double digits.
Mid-double digits. That is a terrifying phrase to hear on an earnings call for a mature dividend-paying company.
It's the kind of phrase that makes people hit the sell button.
A 15, 20, or 25% drop in operating income is the kind of language that triggers algorithmic sell-offs. Why is Q1 going to be such a bloodbath?
Well, it is a combination of real physical damage and the mathematical cruelty of tough comparables.
Let's do the physical damage first.
Okay, physically, as we touched on earlier, the Argo plant did not magically fix itself on December 31st at midnight.
Right. The calendar rolled over, but the pipes were still broken.
Exactly. The operational shutdowns bled directly into a freezing January. That severe cold snap caused further mechanical delays and pipeline issues.
So they're still paying the penalty.
Yes. Management estimated that this Q1 weather and operational spillover is going to hit the books for another $10 million to $15 million in direct penalties.
So they are starting the quarter in a $15 million hole, just from factory overhead.
Right out of the gate.
But you mentioned tough comparables. The math against the prior year is working against them.
In the worst possible way.
How so?
Because in Q1 of the previous year, everything went perfectly for Ingredion.
Oh, I see.
It was a statistical anomaly of operational excellence. The Argo plant ran without a single hiccup.
A miracle.
Right. Their foreign exchange hedges played out perfectly, and their Latin America segment happened to post a record-breaking quarter.
Everything clicked.
Operating income in that prior Q1 was miraculously up 26%.
Oh, wow. So that is a huge spike in the baseline.
Huge. So for Q1 of 2026, you are comparing a stumbling, freezing, mechanically hobbled U.S. segment against a flawless, record-breaking performance from the exact same period last year.
The percentage drop is going to look catastrophic on paper.
Exactly. Even if the underlying business is slowly stabilizing day by day, the year-over-year math looks horrific.
That makes complete sense. The optics are going to be terrible.
But essentially, management is telling Wall Street to brace for a crash landing in Q1 and then asking investors to just trust them that the skies will be clear by the second half of the year.
They claimed on the call that they expect to claw back about $20 million of that Argo penalty in the back half as the plant stabilizes.
Yes, they did.
But if I'm an institutional investor, my immediate question is, do I trust this management team to execute a complex manufacturing turnaround?
Trust is the operative word here.
And that trust equation is heavily complicated by a massive executive shift happening right in the middle of this crisis.
You are referring to the CFO transition.
I am. Jim Gray, the long-tenured chief financial officer, announced his retirement effective March 31st, 2026.
He did.
And as a skeptic, the timing here really raises my eyebrows.
Actually.
He has been the CFO for over 9 years. He has done 35 quarterly earnings calls. That is an eternity in the C-suite of a publicly traded company.
It's a very long run.
If you are the financial architect of a multi-billion-dollar enterprise, and you just promised Wall Street that the flagship Argo plant will absolutely be fixed in the back half of the year,
why leave now?
Why are you leaving in Q1 right at the exact moment your guidance says earnings are going to plunge by mid-double digits?
Is he bailing before the ship truly sinks?
Exactly. Is he getting out while the getting's good?
It is a fair, cynical question that many analysts will internally ask themselves. But if you look at the mechanics of C-suite succession in legacy industrial companies, it paints a much less dramatic picture.
Okay, talk me down from the ledge here.
First, an executive who has served for nearly a decade through the pandemic, supply chain crisis, hyperinflation, and a massive internal resegmentation of the business.
They're probably just tired.
Yeah, they have likely reached a natural exhaustion point. 9 years is a grind.
True.
Second, and more importantly for market confidence, he is not leaving immediately. He is staying through the end of March.
Meaning he is legally signing off on the 10K for the full year 2025.
Yes.
And he is staying to deliver the ugly Q1 2026 news himself.
Precisely. This is key. If there were deep systemic accounting issues or a total collapse of the business model, an outgoing CFO would want to leave before the bad print.
They wouldn't want their name on that quarter.
Right. By staying to deliver the Q1 results, he is absorbing the blow for his successor.
Oh, that makes sense.
He is taking the hit for the Argo failures on his way out the door, allowing the new CFO to step in during Q2 with a clean slate and a narrative of recovery.
It's a controlled demolition.
It is actually a very standard, highly managed transition tactic to protect the incoming executive from inherited blame.
Okay, I can buy that. It is a controlled demolition of the Q1 optics.
Very well put.
But it still leaves the retail investor staring at a very complex puzzle.
It sure does.
We have a booming, highly profitable, clean label and protein business. We have a struggling, mechanically hobbled industrial commodity business. We have a guaranteed terrible Q1 earnings report coming down the pipe.
And a veteran CFO heading for the golf course right as the turnaround begins.
Exactly. So let's synthesize all of this data and move to the ultimate purpose of this deep dive.
Let's do it.
What is the actionable takeaway for you, the listener, the retail investor?
If we strip away the noise and look purely at the cash flow physics and the consumer trends, the verdict on Ingredion is incredibly clear.
Which is?
The stock is short-term bearish, but fundamentally long-term bullish.
I appreciate that clarity. Short-term bearish, long-term bullish. Let's break that thesis down into actionable steps for the two distinct types of listeners we have.
Okay, who are we starting with?
First, let's talk to the current holders. The people who bought INGR months or years ago, who are looking at their portfolio right now, seeing the stock struggle, and listening to us talk about a Q1 crash landing.
Right.
Should they cut their losses and sell before the Q1 print?
If you currently hold the stock, the underlying data strongly suggests you should not panic sell.
Don't hit the big red button.
No. When evaluating a company going through an operational crisis, the very first metric you check is their cash generation.
Because cash is the oxygen that allows a company to survive a turnaround.
Exactly. And as we noted earlier, Ingredion generated nearly $950 million in cash from operations in 2025.
$1 billion in cash.
Right. This is not a fragile tech startup burning through venture capital just to keep the servers running.
No.
This is a massive, highly solvent enterprise that generates nearly $1 billion in hard cash, even when its flagship factory is breaking down.
That's a huge safety net. And they are aggressive about returning that cash to people holding the stock.
They are very aggressive. They pay an 82-cent per share quarterly dividend.
Nice.
And they didn't just maintain that dividend during this chaotic year, they actually increased it.
Wow. Really?
Yeah. This marks their 11th consecutive annual dividend increase. Management is signaling immense confidence in their long-term cash flow by doing that.
But dividends are only one side of the capital return equation. What about the share count?
They are actively shrinking it. They repurchased $224 million of their own outstanding common shares in 2025.
They bought back $224 million in a bad year.
Yep. And during this earnings call, management committed to a baseline floor of at least $100 million in share buybacks for 2026.
Just as a baseline.
Right, with a strong implication that they will buy more if the stock price drops significantly.
Because it becomes a bargain for them.
Exactly. When a company is generating $1 billion in cash, increasing a healthy dividend, and aggressively buying its own stock, you are essentially getting paid a premium to wait out the operational turbulence.
The downside risk is heavily padded by that cash floor.
It is very well insulated.
So the thesis for current holders is patience pays. Let the management team fix the plumbing at Argo while you collect the dividend.
Exactly.
But what about the second group of listeners, the potential buyers? The folks sitting on some cash, looking at Ingredion's 16.9% margins in the THS segment, and wondering if right now is the time to initiate a position.
For potential buyers, the strategy dictated by this transcript is absolute discipline.
Meaning, wait.
Keep your powder dry for just a few more months. Management has literally handed you the algorithmic playbook by pre-announcing the Q1 disaster.
They gave away the ending.
They have told you exactly what is going to happen.
Right. So when those Q1 numbers actually drop in April or May, and the financial headlines flash across the Bloomberg terminals reading, Ingredion operating income plunges double digits.
The market mechanics are entirely predictable.
It's going to be a bloodbath.
Yes. Algorithmic trading bots that scan for negative headline keywords will instantly short the stock. Short-term retail traders who didn't read the full year guidance will panic and sell.
The weak hands will fold.
Exactly.
Oh, yeah.
The stock is highly likely to take a severe, unwarranted dip based on backward-looking data.
And that artificially depressed post-Q1 panic dip is your prime initiation point.
That is the exact moment you strike. You wait for the market to overreact to the Argo penalty.
Because once that Q1 print is finally out of the way, the narrative shifts entirely.
The bad news is fully priced in at that point.
As we move into the back half of 2026, management expects the Argo plant to finally stabilize and claw back that $20 million in operational efficiency.
Right.
And once the legacy anchor stops dragging the financials down, the broader market will suddenly wake up and look at the speedboat.
The THS segment.
Right. They will stop hyperfixating on corn wet milling and start looking at the fact that Ingredion owns a rapidly scaling, high-margin, clean label business that is deeply entrenched in the future of food science.
Which perfectly sets up the broader market realization that I think is the most profound hidden insight of this entire deep dive.
This is exactly why we do this show. Take us beyond the balance sheet. What is the macro realization here?
Well, we spent a significant amount of time detailing the biological mechanics of the GLP-1 weight loss drugs.
The Ozempic effect.
Right. We discussed how it slows gastric emptying, forces consumers to eat fewer calories, and creates a desperate, almost medical necessity for high-density, palatable protein to prevent muscle loss.
It is arguably the most disruptive force to hit the grocery store landscape since the invention of artificial preservatives.
It truly is a paradigm shift. Now, look at how the financial markets are currently trading this trend.
Okay, let's look at it.
Right now, if an investor wants to profit from the GLP-1 supercycle, what do?
They buy the pharmaceutical companies actually manufacturing the drugs. Eli Lilly, Novo Nordisk.
Exactly. But the problem is, the entire world knows about those companies.
It's front page news every day.
Their stocks are already priced for absolute perfection. They're trading at astronomical multiples.
Right.
If their clinical trials miss a single endpoint, or if supply chains glitch, the stocks plummet.
They are highly crowded, high-risk trades at this point.
Precisely. But then you look at a legacy, ostensibly boring agricultural processor like Ingredion.
Boring is good.
They just posted 40% growth in their protein fortification business.
Incredible.
Management explicitly stated they are fully contracted out for the entirety of 2026 for their highly engineered pea proteins and functional fibers.
So they have guaranteed revenue on that front.
The food industry is relying entirely on Ingredion's intellectual property to reformulate their entire product lines to survive the GLP-1 era.
So the provocative question for you, the listener, to mull over as you review your own portfolio is this. Are legacy ingredient companies like Ingredion quietly becoming the ultimate backdoor investment play for the Ozempic era?
It is the purest modern example of the classic pick-and-shovel investment strategy.
The gold rush analogy. I love this.
Right. During the gold rush, the people who made the most reliable fortunes weren't the prospectors out digging for gold.
It was the merchants.
It was the merchants selling the durable picks, the shovels, and the jeans to the miners.
The Levi Strauss model.
Exactly. Ingredion is not taking the multi-billion-dollar clinical trial risk of actually making the weight loss drug.
Right, they're not digging for the gold.
But they are supplying the exact high-margin proprietary ingredients that the entire global food industry desperately needs to stay relevant in a post-GLP-1 world.
They are selling the shovels to Kraft and Nestle.
They are. And if they can just execute basic operational competence, if they can literally just keep the pipes from freezing at their legacy plants, that 16.9% operating margin in their specialized health segment is going to command a massive revaluation from Wall Street.
The market will have to re-rate them.
The foundational pieces for a massive growth cycle are already laid out here. The intellectual property is proven, the consumer demand is locked in via long-term contracts.
And the cash flow floor is rock solid.
The only thing standing between them and a major breakout is fixing the mechanical reality of a wet milling plant in Illinois.
Incredible. We started this deep dive looking at a paradoxical earnings report that honestly seemed to make no mathematical sense.
Falling sales paired with rising margins.
Right. And by digging through the actual mechanics of commodity pricing, the chemistry of clean label food engineering, the brutal physical realities of fixed cost absorption in a freezing factory.
And the biological shifts driven by weight loss drugs.
Exactly. By doing all that, we have uncovered a company undergoing a profound high-stakes metamorphosis.
It highlights exactly why you cannot simply rely on a stock screener to understand a business.
You really can't.
You have to understand the physical reality of how they make their money.
That is the mission. We will leave you with that pick and shovel concept to explore on your own. Keep questioning the simplistic headlines, keep demanding to understand the how and the why behind the numbers, and keep doing your own deep dives into the mechanics of the market.